Right, thank you so much. It's great to be here with everyone. How many of you, can I just have a show of hands, during this holiday period, you've actually gone to Japan? Anyone? Nobody. Wow, thank you for a couple of you. So, ladies and gentlemen, first I just thank you. I saw that running out from the back. I know that, for most people, we know in Japan, where's the best place to eat sushi, ramen, shopping, etc., etc. But when it comes to investing in Japan, most of us will be grossly underweight in our portfolio. So today, though, I want to give you a bit of a breather. I'm not going to be the one doing the presentation. In fact, I'm going to hand the time over to my investment director, who is Junichi Takayama. He's going to be coming to us on video. So he will do the presentation, convince you of the story of Japan. And in the meantime, if you have any questions, we will be over at our Nikko AM booth, ready to ask questions, take questions from you as well. So with that, I'm going to roll it over to Junichi Takayama-san.
Hello, everyone. My name is Junichi Takayama, Investment Director for Japan Equity, based here in Tokyo. So today I'd like to talk about why we think Japanese market offers attractive opportunities in 2023. So first of all, I'd like to show you this chart here on page 2, the left-hand side. Over the past decades, Japanese companies have aggressively invested abroad in an effort to capture global growth, and the trend accelerated in the past 10 years. Japan's foreign direct investments have grown to 28 trillion yen, or about $200 billion in 2019 prior to COVID crisis, quadrupling from 2009. However, recently, Japanese companies are becoming more cautious of the geopolitical risks after seeing the war in Ukraine and the pandemic-related disruptions in their global operations that have been built out over the past decades. Offshoring for low-cost production of goods has been the key driver of globalization, but the trend will inevitably be shifted more towards reshoring, nearshoring, and friendshoring to avoid any disruptions in the supply chain. The increasing focus by companies to engage in ESG and human rights due diligence will also be a factor that drives companies to reorganize their supply chains to bring manufacturing and procurement closer to home. And it's certainly not going to be the beginning of the end of globalization, but companies have started to, optimize their supply chains with a new set of constraints that emerged over the past years, most notably public health, geopolitical risks, and ESG. Right-hand side, we can see some of the major Japanese companies that made decisions last year to diversify manufacturing and to invest more in Japan. And we expect Made in Japan to gain momentum more broadly in various sectors in the new year. And this will certainly have a trickle-down effect, and we expect this to have a positive impact on the overall economy. Now, from an investment perspective, on the next slide, I'd like to show you valuation for Japanese companies. We can see here that on the left-hand side, that Japan is not only undervalued against the US, but also relative to its own history. Price to earnings ratio is just over 12 times and is closer to, is close to the bottom of the trading range over the past several years. So we think that the downside is quite limited and there's a lot of upside risk from here. And on the right-hand side, we can see that we have half of the companies, or about 30% in terms of market cap in the prime market, trading below book value, which is, the liquidation value. So it's clearly an oversold market at the moment with a lot of opportunities. And in terms of economic growth, I'd like to show you the outlook put out by OECD. This is the economic outlook released by OECD last September, Japan is expected to be resilient, outgrowing the US and Eurozone as the delayed reopening effect kicks in a bit later than other markets. And the level of inflation is not as high, contributing to relatively higher consumer confidence. And unlike the US, Japan's GDP hasn't fully recovered to the trend line, given the social restrictions and the closed borders we had last year. So the delayed recovery makes it all attractive. In Japan, we have significant amount of cash in excess savings in the household segment because of COVID over the past few years, which is estimated to be over 50 trillion yen, or about 15% of annual consumption. And there's a lot of pent-up demand as well. So we think Japan is relatively, more resilient and is better positioned than other developed markets. And there's one other factor that's going to give an immediate boost to the economy, but it's not reflected in this OECD outlook, and that is the expected recovery in inbound tourism. Japan had been quite conservative in dealing with COVID over the past 3 years, which is a reflection of the culture and the social norm that puts emphasis on social stability and avoiding uncertainty. Social restrictions were lifted in March last year, but international travels were restricted to control the pandemic until later in the year. And we think that the other reason why Japan was conservative was for political reasons. Japan held an upper house election in July, and as in other countries, senior citizens have high turnouts at the elections, and they're also the most sensitive to public health policies. So the government probably didn't want to take any risk ahead of the election. But with the election behind us, the government is now free from national elections for the next 3 years. And given that COVID cases came down after the summer, the time was ripe to make the change in make the change to the border restrictions. And in fact, as shown on the left-hand side, the Nikkei survey conducted in September, 63% of respondents approved of the measure to relax border control. And the table on the right-hand side shows the actual change in border control measures. Effective October 11th, we no longer have any caps in the number of visitors. COVID tests are no longer required at the immigration. So this is expected to, boost the number of tourists as well as tourist spending. So the question becomes, how likely and how big is the recovery in inbound tourism? And what's the impact on the economy? And we think that it's only a matter of time that inbound tourism will recover and eventually surpass the pre-COVID level. The left bar chart shows the number of international tourist arrivals through September by country, and this is sorted by the number. And Japan comes only after Thailand, and it's down 96% versus the pre-COVID level in 2019. And the world tourists are recovering, as you can see on the left-hand side at the very bottom, only down 37%, whereas, Japan is coming off a low base and is likely to see a huge rebound in the number of tourists this year. And the table on the right-hand side shows the latest ranking of tourism index released by the World Economic Forum in May last year. And Japan tops the ranking and is clearly a popular destination among international tourists. And combine this with, the weaker Japanese yen, Yen has depreciated by about 25% since pre-COVID. And so it's all the more attractive for foreign visitors. So the bottom line here is number of tourists are down 96%, but Japan remains a popular destination and it's cheap. So in fact, it's at the cheapest level in decades in real terms. And from an economic standpoint, the amount spent by inbound tourists was 4.8 trillion yen in 2019, which accounts for about 0.9% of GDP. So this is quite significant. And in terms of the macroeconomic situation in Japan, it'll be increasingly important to monitor the cumulative effect of higher inflation in 2023. In the US and Europe, the surging inflation is considered to be a threat to the economy, and the central banks are focused on deflating aggregate demand in an effort to combat the decades high inflation before it goes out of control. But on the other hand, as a country that suffered from the so-called lost decade and the deflationary period in the early 2000s, inflation may not be all that bad for Japan. And this is because inflation has the potential to break the vicious cycle of disinflation and low wages, which is essentially a chicken and egg problem. And it's widely believed that inflation by nature is driven by self-fulfilling prophecy, and therefore inflation expectation needs to be raised for the actual inflation to move up. In order for inflation expectation to be positive, ideally close to 2%, there will have to be an exogenous shock that becomes a catalyst, and the recent rise in import prices may have been what we needed. And while we do need to make a distinction between certain purchasing items with rising prices driven by higher commodity prices and those that are seeing chronic deflation, at an aggregate level, we are seeing the inflation rate pick up, as you can see, and the latest reading was 3.7%. And while the inflation rate itself is lower than in the US and Europe, the good news may be that we're actually finally starting to see signs of inflation expectation picking up in Japan in line with actual inflation. We found some interesting results in a survey conducted by University of Tokyo professor Tsutomu Watanabe. People appear to have become more resilient to an increase in the price level. This is a household survey conducted at two different points in time. And among all the questions, one of the questions asked was, what would you do if the price of a product that you always buy at a supermarket rises by 10%? Japanese consumers had historically been quite sensitive to prices, and as you can see in the August 2021 survey on the left-hand side, higher percentage of Japanese consumers answered that they would go somewhere else if they find higher prices for certain staple products at a supermarket. 57% of respondents said they would switch to a different supermarket. But what happened was that in the April 2022 survey on the right-hand side, this percentage dropped significantly to 44%. And on the other hand, 56% answered that they would stick to the same store despite the price hike. And this is quite a remarkable change in the consumer attitude. And we think this change in inflation expectation has the potential to end the broad-based deflationary mindset, which could lead to a virtuous cycle in the economy. In Japan, every year in spring, we have what we call shunto, or the spring wage offensive, where management teams and labor unions sit down to negotiate wages for the coming fiscal year. Corporate earnings have been solid, and the outlook is quite positive, as indicated by earnings guidance, and increasing amount of share buybacks, which signals the management team's confidence. And so there's an increasing amount of pressure on companies to raise wages now that inflation and expected inflation have finally started to move up in Japan. And Prime Minister Kishida is calling for higher wages in his new form of capitalism economic agenda, and considers wage hikes to be critical in creating a virtuous cycle of growth and distribution. Labor unions are also becoming aggressive in calling for higher wages. Rengo, which is the largest national trade union center in Japan, is calling for a 5% wage hike in order to cover the recent rise in the price level ahead of Shinto. And higher wages will clearly be positive for consumption, as households have a lot of pent-up demand. And this would also have implications for monetary policy in Japan. Wage hikes could pave the way for the BOJ, Bank of Japan, to pivot following the change in governor in April. And just to remind you, the current governor, Kuroda, his term ends in April. So we'll have a new governor in a couple of months. So there will be many news flows on the spring wage negotiations, and we need to carefully monitor the situation and see how it goes. And any change or signs of a change in monetary policy could have a significant impact on the currency, as we just saw after Bank of Japan tweaked its policy in December. Next slide, please. As you know, Japanese yen has depreciated significantly over the past 12 months. This chart here shows MSCI World Index against Japanese Broad Market Index, the TOPIX index in both US dollar terms and Japanese yen terms. And the light blue is the TOPIX index in Japanese yen terms and is keeping pace with the World Equity Index. However, for the US dollar-based investors, the currency loss outweighed any gains in the stock market itself, leading to a negative return in the past 2 years. As we saw on one of my earlier slides, Japanese market is undervalued, and if the currency is going to be either stable or to reverse course, we expect this will be a catalyst for US dollar-based investors to reconsider getting back into the Japanese market. And we're actually starting to see foreign investors coming back into the market in the fourth quarter of last year. And in the US, we expect the Fed to continue to slow down the pace of its monetary tightening this year. So narrowing of the interest rate differential between the US and Japan on the back of the Fed becoming less hawkish, Bank of Japan becoming less dovish, will likely result in reversal in the currency movement, meaning stronger yen, which would be positive for dollar-based investors, as currency gains can be expected to be on the top of capital gains. And given that foreign investors dominate the trading in the Tokyo market, we expect it'll be positive for the overall market. And again, here we can see how the Japanese yen had the worst performance among all major currencies in 2022. And on the right-hand side, we can see that the yen is overshooting now. The dark blue line is the level of purchasing power parity as estimated by OECD, implying that the current level of the yen is significantly undervalued relative to its theoretical value. As of the end of November, the discount was about 27%. So the bottom line here is that it's not just the overall equity market that's undervalued, but also the currency is undervalued, which means that we have an opportunity to profit from both capital market appreciation and the gains on the currency. And finally, I wanted to touch briefly on the corporate governance situation, where we stand on the corporate governance reform. Since Japan first introduced the Stewardship Code and Corporate Governance Code in 2014 and 2015, there's been a lot of changes made at companies. There have been more independent directors being adopted, and capital efficiency targets such as ROE or ROIC have been introduced at many companies. And returns to shareholders, including dividends and buybacks, have also grown significantly and with higher transparency. And outside of companies, there's been a significant growth in the number of activist investors entering the Japanese market. They pressure companies to, unlock and create shareholders' value. But the ongoing unwinding of cross-shareholdings by the companies and the increasing pressure by traditional institutional shareholders from, stricter proxy voting guidelines make the market more attractive for activist investors, because value is expected to be unlocked by leveraging the support from traditional institutional shareholders. And last year in September, Prime Minister Kishida gave a speech at the New York Stock Exchange and made it clear that corporate governance reform is front and center and will be accelerated going forward. And he talked about establishing a forum to hear from global investors on corporate governance issues. And following his speech, the Financial Services Agency has held talks with the Asian Corporate Governance Association, as well as the International Corporate Governance Network. And the third meeting is to be scheduled with a group of US-based investors in the new year. And we believe that these discussions will continue to be reflected in future policies and guidelines which will contribute to unlocking and creating value in the new year and beyond. This concludes my presentation. Thank you very much.
All right, thank you, Junichi Takayama-san. So, ladies and gentlemen, I hope that gives you a very good insight and overview in terms of the Japan market. Lastly, just to summarize, there are values to be found within the Japan market. There are many reasons to support the market, and if you'd like to find out a little bit more, once again, we're at the very, very first booth near the entrance. Come and look for us. My name is Darius. Enjoy the rest of the Saturday afternoon. Thank you very much.